I have been trading for the past 3+ years, and if I had to go back and restart my journey knowing all I know now, this simple and repeatable strategy is what I would use to shorten my learning curve and remove all the guesswork from my trading. In this video, I'm going to be sharing with you why you should use this strategy, how to enter and exit using this strategy, and most importantly, useful tips so that you can shorten your learning curve. Why should you trade this strategy? Number one, it has simple steps and it is repetitive. When you have a strategy that you can execute in simple steps and then you're able to repeat it every single day, it's only a matter of time before you master that strategy and you're able to just solve half the battle in trading. And you can execute this strategy without bias. How many times have you come into the day and you have a strong bias that, okay, today we are going to sell, and it doesn't happen? Or you come in with the opposite mindset, oh, today it's all bias, and it doesn't happen. This strategy helps remove that bias and you're just able to trade what you see and not what you think. Now, in this video, I will be sharing the foundation of the strategy and the steps for entering and exiting trades, the different scenarios that present themselves and how to trade them, along with useful tips so that you can avoid low probability setups. At the end of this video, I'm going to be sharing useful tips to help you avoid the low probability ones, because it's not going to work 100% of the time, but if you're able to then avoid the ones that are the setups that are less likely to work, that then increases your win rate. And I'm going to be sharing a free indicator that you can use in TradingView to help you execute the trades faster. It just like skips a step for you. Now, the foundation of this strategy. You want to understand the foundation, because without understanding the why, it's hard to buy in and even use a strategy with conviction. Now, this strategy is based on the previous day's high and the previous day's low of the asset you're trading. Yes, it works on futures, it works on stocks, and it works on crypto. The reason why you mark out the previous day's high and previous day's low is because these levels have the most liquidity where the buyers are present. That's the foundation of this strategy. We are trading based on what price is doing, either above the previous day's high or below the previous day's high. And another scenario that most people don't talk about on YouTube is what happens when it's in between that range. And I'm going to be showing you an example of how to trade it. Like I said, there are three scenarios I'm going to be discussing in this video: when price is above the previous day's high, when price is below the previous day's low, and lastly, when price is between the previous day's high and previous day's low. I'm going to be going over an example in detail and breaking it down how to set up your trade idea and execute it. Now, as for the steps, step one obviously is to go on the daily time frame. And once you're on the daily time frame, step two is to draw the key levels. And as discussed, the key levels are the previous day's high and the previous day's low. Once you have done that, now I am going to now walk you through different scenarios that play out in the market every single day so that you can also backtest this and see that it works, and then implement it in your trading and make the tweaks to the strategy based on the useful tips I'm going to share later on in this video. So stick around. Now, once we have marked out the previous day's high and previous day's low, and we are coming into the day, we are trading the New York session, which opens at 9:30 a.m. Eastern time. This is showing 6:30 a.m. because I am on the West Coast. That's why it's showing 6:30. Ignore the time. But once you mark out your levels, now for this example, we are trying to see if price maintains above this previous day's high, and we see something like this: push up, right? Retest, and then continue higher. The opposite is true if we are looking for price to break below the previous day's low and retest and then continue lower. This is just plain market structure and liquidity levels. Now I'm going to play out the tape and we are going to look for a nice entry and exit, and we manage our risk accordingly. So now let's play out this tape and look for a setup. As you can see, now we have pushed higher, we have displacement. Now let's see if price will come back and retest this level. We're watching and price is coming back down. We are alert, watching to see what kind of price action we get. Okay, sellers are trying to push price. I'm gonna stop this here. As you can see, sellers are trying to push price lower, right? Sellers are trying to push price lower, but buyers are present. Buyers are present and trying. They're fighting at that level. Now, watch. The most important candle here. I talk about this candle. It's one of my favorites. Sellers try to push price lower, and as you can see, we have formed this lower wick, which shows that buyers stepped up and closed it strong at this level. So now we're not just going to enter yet, we're just observing what's happening around the key levels. Remember, I said we only pay attention to the candlesticks around your key levels. Anywhere else is just formations. Look at that. Buyers stepped up nicely. So now I am going to look to enter a trade, right? We look to enter a trade here. We would look to enter a trade here. We know that this is TradingView replay, so I'm not going to actually just place the trade. I'm just going to show you how to execute it in real time. So now I always preach, look for a 1 to 2 risk to reward, or 1 to 1.5, because this strategy has a high win rate. If you follow everything I'm going to explain in this video and use the useful tips at the end of this video, you're going to have a win rate of at least 50%, which means that you can get away with a risk to reward of 1 to 1.5. Meaning if you're risking $100, you're looking to make 150. So now, assuming we enter this trade once this candle closed, now I'm going to play it out. I'm going to see if this trade ended up stopping us out or if it worked out. Now, as you can see, it's playing out nicely and we're almost at our target. Let's see if it works. Just have to allow it play out. The thing is, some people are going to be like, oh, you cherry picked this example. No, I literally picked an example that is most recent and applicable in today's market. I didn't go back 2 years ago to look for this setup. So as you can see, it worked out nicely and you would have taken your profit and held runners if you have enough shares or you have a large account to capture the move if we get continuation. But I'm going to end this example here and show you the opposite, where we're looking for setups towards the downside. So now with this example, coming into the day, we've marked our previous day's low, which is yesterday's low. And of course, yesterday's high is way above here, meaning that we have gapped down and we are below the pre-market high. Now, you just have to wait for one of two things to happen. We simply look for a setup like this, where we move up and then come back down, or we even get up here, then do something like this, and then come back down. This scenario is my favorite because what this means is that we failed to go higher. We broke below the previous day's low. Then we retested it. We saw weakness and we're looking for downside. That's how you read the price action, and price action will guide you on how to take this trade and execute the trade. But now I'm going to play it out and see if we find a setup. Now we've broken below the previous day's low, right? We failed to go higher. Now let's look for a retest and see if we get a downside move. Price pushed up here. We saw weakness. Now we're going to be even way more alert now to see what forms next. See if we can find an entry. So we saw that we rejected. Now we have a bearish candle that engulfed this candle. That shows weakness. Now we can enter this trade and look for a 1:2 or 1:1.5, like I said, and your stop is going to be simply the break above this candle's high right here, based on price action as well. And we know that if price ends up reclaiming the previous day's low, then your idea is wrong and you just exit the trade for a loss. This time it just did not work. Probabilities did not play out. So now we would watch to see if this setup works. Some people would even call this a head and shoulders pattern. It's all liquidity, right? Like price, failure here, and then failure here again. Look at it playing out. Let's see if we get the move towards the downside or not. More rejections here. And don't get me wrong, nothing is stopping you from targeting pre-market low. Absolutely nothing. But for the sake of my examples and showing you what works, a 1:2 risk to reward is enough to make you a profitable trader as long as your win rate is around 50%. With this strategy, it is around 50%. Have to sit through a lot of chop with this trade, but we allow it play out. So far, weak price action. I'm just going to speed it up and see what happens. Finally, look at that. So there's nothing like, because pre-market low is a liquidity level, price will gravitate towards it. As long as there's enough participants and enough volume and the selling is strong, it will gravitate towards it. So you could have targeted that, or you could have even gone with your 1:2 and you would have still made money. You've still gotten a piece of the move. So that's the example with when price is below the previous day's low. Now I'm going to show you a trade I also took of when price is in between the previous day's high and previous day's low. If you're just starting out and you're learning this strategy, I do not recommend you trade it, but it's also good to just know. And in this example, coming into the day, you can see that we are currently below the previous day's low and we're in between the pre-market high and pre-market low. So the thesis most people will be coming in with is, oh, let's look for the previous day's lows retest for downside, which is also correct. But let's play out this tape and see what happens. So as you can see here, we did not fail. Instead, we saw strength. And this is why I have a rule of thumb that I like to go with when I'm looking for downside setups, is that price should be trading below the opening print for downside setups to have a high chance of working out. Doesn't mean that it's not going to work out, but the chances of it working out goes from like 70% to 90% if we are below the opening print. And if you're a beginner and you just want to make things very simple for yourself, once you add that rule, you would see that your win rate will also increase. It means that you also miss some setups, but it would help you take better trades. So in this example, it's a nice uptrend after the first 5 minutes, even 15 minutes. It's a nice uptrend, and we are now back in between yesterday's highs and yesterday's lows. Some traders will tell you, yeah, there's no setup, skip it. But I'm here to show you that you can actually take a trade using the previous day's low towards the upside, and I'll show you. The reason for this is because when price reclaims the previous day's low, sentiment has flipped. You're not now looking for downside. You're now looking for upside, and you could even target the previous day's high if there's enough strength. So let's see if we can find an entry for a retest to happen, and then we take a trade towards the upside. So now, just look at this, even based on market structure, right? Higher lows, higher highs. You had this happen. We came back, held the pre-market high. We pushed higher. Now we are forming a higher low. Now, what we want to see is if price will hold this area, and then if we can then push towards the upside. I hope this is making sense. If you just started your trading journey, you can skip this scenario. When you see it, you can just maybe watch it happen and see if it works out. If you're more experienced, you can try it out and see. You have to understand and how to read market structure, because sometimes the perfect retest might not happen. In this case, look at the strong candle that is showing. It didn't even get to this level yet. It shows that buyers are really strong. So in this case, right, I know what happens because I took the trade. I know what happened because I took the trade. That's why I'm able to just foreshadow and tell you what happens and spoil it a little bit. But this is where your stop loss will now be, right? This higher low will be your stop loss. And then now you can target a 1:2 risk to reward and play it out. Look at that. Almost got stopped out, but you get the point. Price action is king at the end of the day. Price action wins. You need to understand it and be able to read it at key levels. Again, candlesticks at key levels, what's happening around your area of interest, and also using price action to be able to take these trades. So this is an example of what happens when price is in between your previous day's high and your previous day's low. Like I said, I'm not going to leave this video without giving you useful tips. Tip number 1, this strategy works best before 11 a.m. Eastern time. the market has the most volume. The New York session has the most volume within the first 2 hours. That's where you have momentum. That's where you have the strong moves, high probability trades, because there's more participants. And if you're right and you take the right setups, it would work right away. If you're wrong, you're wrong right away and you get stopped out of the trade. If you end up taking a trade after 11 a.m. Eastern time, you want to manage that setup on the 5-minute time frame and not the 1 minute, and you have to give that trade a lot of time to work, because at that point volume and momentum has slowed down. So it's best to use it within the first 2 hours of the New York session. That's the session that I have back tested, and I've used this strategy a lot. Number 2 is the most important, and if you don't understand, please leave a comment below and I will explain. But I have drawn something to show you what I mean. If price is between pre-market high and pre-market low and previous day's high and previous day's low, consider skipping the trade. What do I mean? The market opens up here and price is just trading here. Please just consider skipping the trade. The chances of the trade working out are lower, and it's just not worth it, especially if you're trading with smaller capital. Just skip the trade, look for another ticker or stock or asset that has a better setup and entry criteria. I have a special announcement. I have the live stream coming soon. I'm going to announce it, and we're going to be live streaming every weekend moving forward. It's going to be on Sundays, most likely, just finalizing the details. As promised, the name of this indicator that draws the pre-market high and pre-market low for you, depending on the session you're trading, is Key Levels by Liquid Trader. I really like this indicator. So once you go to indicators, you search key levels, it comes up. It's already marked as a favorite for me because I already have it, but it should come up, and then all you need to do is to star it, click on it, and it should come up right here on your TradingView, and then you can adjust the settings to your preference. For me, I just want to see pre-market and yesterday's highs and lows, right? And I put the time that I'm interested in. So I put the 9:30 to 4 o'clock, which is the New York session hours, down here. You can adjust it for whatever session you're trading, whether it's London or Asia, to suit for you. But I recommend, if you're going to use this strategy, use it on the New York, use it during the New York session. That's it. It's that simple. You come in, it's already plotted for you. You don't even have to do it yourself. If you enjoyed this video and you found value and you have any questions, just leave a comment below and I'll do my best to answer. Thank you so much for watching. I'll see you